Afternoon, everyone. We're just waiting for a couple more to join. Um, welcome to this Invest Engine webinar in partnership with Fidelity International. So, today we're going to be looking at the Age of Empires, rebuilding in a diverging world. We're going to be hearing from Elliot and Goncalo from Invest Engine. So there's going to be a presentation that's going to run, and please feel free to ask questions as we go. Those questions will probably won't appear to you on the screen, but we'll see them here and we'll be able to kind of cover them as we go. We'll move on to the intros. So my name's Kieran Darwin. I'm one of the senior agency partners at Yahoo Finance. Also joined today by Elliot Date from Fidelity International, so one of the national development senior managers, and also Goncalo Machado from Invest Engine.
Right. Good afternoon. I do want to mention the usual disclaimer that your capital is at risk whenever you invest. This webinar is intended for UK clients only, and that information in this webinar should not be treated as financial advice or a recommendation to buy or sell securities. And as always, past performance is not an indication of future returns. And without further ado, I'll hand it back to Kieran.
Thank you. So we're going to go through the presentation now, which Elliot is going to kindly run over. So I'll hand back to him.
Great, thank you, Kieran. Good afternoon, everybody. Thank you very much for making the time to dial in this afternoon. It's a pleasure to see so many people. Now, for those of you that don't know me, as I said, my name is Elliot Date from Fidelity. I've been at Fidelity for 11 years. And for today's presentation, we're going to be looking at the age of empires. And history has shown us that nothing is ever static. Empires rise and fall throughout all of human history. And particularly in the last 500 years, we've seen a real advancement in this cycle that we've been looking at. And then when we look at where we are today in that current market cycle and lots of the news that is out there, heavily focused towards the US, specifically, we then look at that from a Fidelity International lens. We're really thinking about how we as investors have to start maybe changing some of our thinking. But specifically, we're thinking about rebuilding in a diverging world. Now, over the next sort of 20 minutes or so, we're going to run through these slides. We're going to start by looking at the big economic cycle. We're then going to look at some of the opportunities that we might see out there and also have a deep dive into the US, as Kieran rightly alluded to. So we'll start by thinking about, well, what is this big cycle that I've mentioned? And everyone on this call will already know what a cycle is. We have a daily cycle that takes 24 hours. We have the seasons that take 12 months. But something that people really don't like to think about, but we are just animals. And we have a life cycle, which is about 81 years on average. Now, if we take a step back, you can think of it from an economic lens as well. Now, when they're thinking about this breakdown in terms of an economic lens, I think the key thing to note, this is the life cycle that an empire goes through. And usually this takes 250 years on average to play out, but is speeding up due to the advancement of technology. Now, when we zoom in on these specifically, we see this new world order. That's usually after a new world power has established itself as the leading empire, and that brings with it a huge amount of peace, productivity from an entrepreneurial lens, the rise of education, but also with that productivity growth we see for empires and their economy, that then gives rise to the first financial bubble, where we then start to see a growing wealth gap between the haves and the have-nots. Now, somewhere along that line, we then see them become less competitive. So their empire becomes very expensive. They often start exporting or importing. And of course, their marketplace competitiveness declines. Now, we know nobody wants to lose being number one. So we then see a number of money printing and credit trying to hang on to that top spot. And there's history is very well evidenced from this. We see a revolution and war, and then political restructuring, and then that cycle just repeats again.
Elliot, just to jump in there, as a retail investor, how can I identify which phase of the economic market cycle we're in, and what do you think are the kind of key indicators we could be watching for there?
No, that's a great question. I think, as a retail investor, I mean, I very simply would just go back to, where are we when you look at that currently and you start thinking about where we are. Now, some of the tools that you can be looking at is how much government debt is out there, just very simply from certain economies, which part of the world is doing maybe better than others as well. So I think you just have to be clued in. I mean, dare to say it, watching the news and just being fully, aware of what is happening around you.
Okay, great. And just to build on that, actually, one of the questions that's come through in the chat: can empires survive more than one financial bubble, do you think?
Absolutely. Absolutely, they can. Empires, we know, are very resilient things, particularly, I think, from an economic standpoint. We know that a huge amount of inventiveness, particularly from entrepreneurs, can really help to steer that. And technology is one of the main reasons for that as well, as history is very well evidenced.
Okay, great. Thank you.
No, it's all right. You're very welcome. Well, look, let's keep it interactive, right? You've already mentioned you've been getting some questions in from the chat box. Now, if anyone has seen me present before, I'm a fan of keeping my presentations interactive. So we'll start with a couple of questions, just 3 quick ones to kick us off. Now, the answer to these questions will either be the British Empire or the Dutch Empire, because they're the most recent in the last 500 years, excluding the US. Now, first question, I'm going to give you roughly 10 seconds to answer it. So do get them down in the chat box, which is, which empire's press was once captivated by a scandal involving a supposed duck that laid golden eggs? Was it the Dutch? Was it the British? A couple of seconds, get them in the chat. Right, I'm going to call time on that. Hopefully you've managed to get them in. For anyone that said British, you are correct. You're thinking of the Golden Duck of Bombay, which captivated the British public back in the late 1800s. So well done, give yourself a point. Second question. Now, what empire once used cheese wheels as cannonballs during a siege? Again, was that the British or was that the Dutch? 10 seconds, get them in. I mean, it's certainly not deadly, but maybe memorable. Now, if anyone guessed the Dutch, you'd be correct. Now, my final question, when I read this question, I always like to think of myself as this, particularly around Christmas, as, dare I say it, we're moving that way, and I'm always a little bit too generous at those Christmas parties. So which empire had a governor who kept such a generous open bar policy that sailors would extend their tours just to enjoy their gin-soaked hospitality? Again, the British or the Dutch? Again, a couple of seconds, get them down in the chat box. Now, for anyone that said the British, you'd actually be incorrect. It was the Dutch. Now, that did surprise me when I put that together. But look, we'll put that bit of fun to the side, and then we'll see why this is so relevant to those themes that I was just mentioning a moment ago. So if I then take the Dutch Empire, we know a huge amount of wealth poured in to the Dutch Empire because they were one of the first empires to really conquer the seas. And the main bubble that we saw across that empire was the tulip bubble, which is so well documented, where the average price of a tulip bulb was 5.5 times the average yearly salary. And you can still buy the same tulip bulbs in Amsterdam's airport for about £15. So how things have changed. Now, we know just as they were starting to indulge in their wealth, the Dutch nobles, though, were very keen on that. But the key thing to note here is this is the same time the British had begun building ships at a quicker, faster, and more advanced rate. And that then led to the oncoming war between the Dutch and the British Empire. Now, we know the British Empire rose from that victorious. And we saw, again, our expansion of our own empire, conquering the seas, bringing with it a huge amount of wealth, technological advancement, and giving rise to the railway bubble, which we saw over £4 billion in today's value just lost in too ambitious, just too challenging projects at the time. Now, key thing to note here, with that rise of industrial Victorian Britain and the railway bubble, America had become our main competitor in terms of steel and manufacturing production. And then we saw World War I and World War II, which really was the first time in history we've seen the handing over of power from the leading empire to that of an ally. And it's the only time, as I mentioned, in history this has happened. And we then think about, well, where are we now? We start to think about the US, and you can start to make an assumption of some of those points I mentioned at the moments ago. We are now seeing the world starting to change, and we have to be aware that, we're seeing a huge amount of technological advancement, but also some challenges on the horizon as well. Now, if we then break that down, again, I'm going to lay these across the bottom. Oh, sorry, Kieran, I think you're about to say something.
Yeah, sorry, no, I was just going to say, in terms of what type of investments would typically perform well during each stage of the business cycle?
It's a good question. Now, I mean, obviously, for compliance reasons, I can't go into too much detail on these, but if we just sort of break it into two sets of three, effectively. If we think early stage in the cycle, we're thinking very much around risk assets, equities, credits, so stocks, bonds, maybe some private equity as well. I mean, that can be very difficult to get access to as well. But the idea is to be very well diversified in what we class as riskier assets. Then somewhere around the top, you can maybe make the assumption that maybe you're in that mid-cycle phase, defensive, quality, maybe diversification, again, still being very key because, of course, timing these things is very, very challenging. And to be honest, I don't think anybody ever really, truly gets it right. And then last, of course, you think in late cycle, we're thinking real assets, gold, commodities, protectionism really feeding through. But again, I mean, I think for anyone that's really worried about that, that is not investment advice. They need to be seeing a financial advisor because they can take that conversation to the next level, I think, to support them. Because, of course, it's a very challenging time.
Of course. And as a retail investor, you mentioned diversification and we talked about, looking at different asset classes. How should, if you had kind of some generalist advice for a retail investor, how should they be adjusting their portfolio accordingly? Is it just more about the kind of protection phase? Is that the biggest thing you think that people should be looking at?
Yeah, I mean, it's a very, very tough question to answer because, of course, for everybody, everyone's assumption of safety or protection is very, very different. People will be much more risky than some other people. I think if we're looking at where we are in the world, you could be correct probably saying with that assumption that maybe now is the time to be being a bit more risk averse and maybe thinking about a bit more protectionism in terms of diversification. But again, I would have to go back to, I think you need to be thinking about, if you are really concerned with where we are in the world, maybe getting some professional help. I think that's probably going to be the best space because they can really dive in, say, what's your risk assumptions and help to really, really steady your portfolio moving forward.
Sure, all makes perfect sense.
No, thank you, Kieran. Well, look, if I just break that down briefly, I'll run you through, as I think, where we are when you look at the US. That new world order, post-World War II, you've got the creation of the World Bank, the IMF. You then see peace, productivity, the rise of the baby boomers in the US, and they started selling not just manufacturing, but also the American dream and how prevalent that is across Hollywood, even in today's films as well. Growing bubble, I think you've got to think of the tech bubble. It's so well documented everywhere you see. But, talking about bubbles ending and maybe carrying on, the US has really been the place to be to make money. But we saw the tech bubble after that. The NASDAQ dropped 72%. And I was only 6 at the time when that happened. But, these things do happen. People have to be aware there is risks when you're thinking about markets. Then you think about less productivity, competitiveness declining, mid-2000s, start outsourcing to China, we know from an economic lens. Money printing and credit, I'm being honest, looking at the US now, we're seeing $37 trillion in debt. They're spending billions of dollars every single month in interest payments. And then revolution and war, debt, political restructuring. I think, are we going to see a hot war? I mean, who knows? But I do think, the war front is definitely changing. It could be an information war as you move forward. But I do think we have to say and be realists as we look forward. The world is changing. I'm going to be a bit cheeky, as I always am in my presentations, and say, well, who is the empire that might lead in the future? It could be China. They are very, very well advanced, we know, in a number of these areas. But I think you could also play devil's advocate and say, well, technology in the US is creeping on. We're seeing a huge amount of advancements from the likes of digital assets, etc., that Trump seems to be talking heavily about. But even away from that, you've got India, the rise of the Middle East. The world is changing. But I think just for this, I'm going to be cheeky and say it could well be China, I think, might be leading forward, which then has this diverging world narrative, the East versus West, G7 here in the East or in the West, and then you've got the BRICS nations over in the East as well.
That's really interesting. And in terms of how different regions such as the US, Europe, emerging markets recover at different paces, was that something that was very noticeable in terms of a differentiation point between each market?
Here again, you have some good questions there. I would say it is tough when you think about diversification and where's been the best place to make money to that point across all of these different markets is pretty quite a nice setup because this goes back to 2009. So this is the fallout of the global financial crisis you can see in just in 2009. We've then broken it down from what we call large cap equity, so large stocks within these markets. So you've got the US in red, Europe in blue, Japan in orange, and China in yellow. And I said, fallout of the global financial crisis in 2009. No surprise to see all markets dropping there. Then in 2012, you saw Mario Draghi's European Central Bank. We will do whatever it takes, a very famous speech. You can see it on YouTube. It's got millions of views on there. And in 2012, Fed raised rates for the first time since 2006, which is a very different world to what we're living in now. And then as you start to look forward, everyone will be more aware of COVID and more recent history. But again, to my point, the US, even despite some of those challenges we've mentioned, has been the best place to make money. And that's what you can see here as we then start to look forward. But with that, of course, and to your point around diversification, volatility, it's been a very bumpy year for the US market, but also for some markets in general. And if I zoom just in on the US specifically, we started to see that change of happening in sort of what's been driving it forward. Now, in front of you, you've got the year-to-date performance for the US Mag 7 in blue, which is the magnificent seven names that everyone will be aware of. You're thinking of Apple, Amazon, etc. But then in orange, I've got China's Big Tech 8. Now, at the beginning of this year, we know the Mag 7 was really driving the returns, particularly over in the US. But really what then started to bring some question marks around some of their business models was the DeepSeek AI earlier this year, which we saw a company worth $157 million wipe 2.3 trillion in market cap off of those seven names, because they just started to bring out some question marks around how sustainable their business models are. Are they really advancing for the future? Could the same things be done with cheaper technology as well? So what we did see was a huge concentration of wealth with that US, and then some question marks, again, to your point around diversification has been creeping up. And that isn't the only place we're seeing challenges in terms of volatility from business models, but also question marks around leadership within the US as well. We've got Donald Trump, and really what shocked the markets earlier this year was what he stood up and said on Liberation Day, besides tariff being his favorite word in the dictionary, is that really he started by announcing 58 tariffs globally. Only now, though, that of course shocked the market. We saw the volatility index of the VIX hitting highs not seen since the global financial crisis and COVID March 2020. I think everybody remembers quite that was all over the news and how people felt at that same time. Well, that was exactly how the markets felt during April. But now, if we look to where we are today with some of the trade talks that are happening with China, very recently some of the challenges with India that he's been putting out there as well, really we've actually seen the VIX index being below its long-term average. I think really showing that the market is looking forward and saying they're starting to discount some of these shock politics that Trump has been talking about and actually looking to what is likely to come next. And with that, we've seen the rise of the taco trade, as it's been called, which is Trump always chickens out and whether it's going to continue moving forward. But I think even if you leave all of that away, you look at what has Trump's tariffs really done. It's been three countries that have been majorly impacted: Canada, Mexico, and China. Main likely components of that really has been around the commodities market, which has been copper, steel, aluminium, all of which have over a 50% weighting on tariffs. And that's on top of the overall 10% increase in tariffs for everybody globally. Now, besides drawing up some of these foreign policy sort of trade lines, as it were, I think the one thing that really gets missed with this, and I think everyone on the call might feel the same as well, is just how the underlying consumer, people's households are feeling about this. And Forbes did a study in August that showed that 62% of US households are starting to feel concerned that Trump's tariffs are going to have some impact on their monthly paycheck. And I think we saw that earlier this year when Jeff Bezos announced that Amazon was going to add on that little extra cost just to highlight the extra tariff that Trump had implemented for them. We saw a very quick backlash from the Trump administration towards Jeff Bezos around getting that taken off of the online. So I really think the world is quite an interesting place. And I think as we're looking forward, as we're all investors are constantly doing and constantly evaluating it, and we're thinking about the US specifically here, is how else, what do we need to be aware of from some of these scenarios? Now, as I mentioned earlier, from a compliance perspective, I can't go into too much detail on these. And for anyone that wants to go into more detail, I think definitely reach out to a financial advisor. But Fidelity has 4 scenarios that we're currently looking at, but these things can change for the US. Now, our top 2 scenarios are what's called stagflation, so a low growth or moderate inflationary environment, and a slowdown, so a slowdown in economic growth, both of which we're given a 40% weighting to. Then we see a cyclical recession based at 20% weighting. So you're saying, well, Elliot, that's 100%. And really this came out because we're seeing some of the policies that Trump has been talking about in the US, thinking around how which maybe he's going to replace Jerome Powell, maybe start to bring in somebody that's maybe not going to listen to what the markets are needing, actually look to bring rates down. We've got a reflation in target there as well, which means seeing an increase in inflation of 0%. So it's something we're just watching at the moment. We haven't given a weighting to. And just to give you guys a bit more flavor on this, we've got growth, so GDP, so the growth of the economy on the bottom. On the left-hand side, you can see the inflation rate. Now, I'm just going to start to load these up so the people on the call can start to get a sense of where this likely starts to fit. Now, I think scenario one, scenario two, I think really the key thing to note here is around that economic data, and particularly Jerome Powell, and what is going to happen with interest rates within the US. We know the jobs numbers in the US have been revised down very heavily. Much more recently, we mentioned the worst jobs report within 20 years in the US. We saw the Fed cut rates 25 basis points just the other week. And actually now the market is pricing in 2 more rate cuts looking towards the end of the year and 1 more into 2026 to try and provide some stability for businesses. We know as rates start to come down, liquidity goes back into the system, helps with economic growth. So I think we're really going to have to wait to see, giving them an equal weighting as to where we start to move forward. So again, we'll have to wait to see how this transpires. Now, cyclical recession, we're not expecting to see huge, sharp downturns, but again, you never know. Anything is possible in markets. So what it's likely to we see from, I'm only giving it a 20% weighting, is a slowdown of -1% GDP in economic growth, given some of the data that we have seen. And that then continues into 2026. But again, things are changing, rates are coming down, it might start to move forward. And then reflation on the right-hand side, we've then just given that example of what that would look like. Slightly higher growth, but of course that inflation story still being very, very prevalent as well. So Kieran, I'm going to put it all back together for you though, and think about that longer term perspective for investors and where we need to be thinking about. And, you know, as I said, always reach out to a financial advisor if you're in doubt, but this is just to give everyone an idea. So in front of you, this goes back to 1970. And in blue shows when Europe, Africa, and the Far East outperform in terms of markets. And in red shows when the US outperforms. Now, as you can see, the US has really, as I said, been the best place to make money. But actually, from the start of this year, we have seen other increases around the world doing very well as well, which you can see just on that far right-hand side with blue as well. So I do think, just to recap, as we're looking to the future, you know, being sensitive to where we are in that larger cycle, it may bring new opportunities. But of course, as I said, these things aren't guaranteed, and we could see the US continue, and also maybe the rest of the world start to continue as well, because you know the US has also made new all-time highs recently. But that divergence we think is likely to continue, and as will it. Volatility is really going to be a theme we think over the next couple of years, and investors, you might want to consider blending an active and a passive approach for some solutions to add some value and diversification into the portfolio, maybe leaning on some research with that as well. But then also with those different scenarios likely for the US, we do think it's important to remain focused, particularly on the next few months with some of that economic data that I mentioned a moment ago. And of course, everyone here, of course, if you adjust your approach accordingly, and if anyone is in doubt with that, you know, please do start to consider maybe reaching out to a financial professional, so a financial advisor to help steer you through that.
Thanks, Elliot. That was really interesting. Some really good points in there, and some really interesting themes. Just for everyone on the call, we're now going to hand over to Goncalo, who's going to talk on the Invest Engine side of things. But the chat is still open for questions, which we're going to come back to at the end. So if anybody has got anything that they want to ask, then please type that in the chat box, and we will follow up with that at the end. But for now, I'll hand over to Goncalo.
Thank you very much, chaps. It's very insightful, Elliot. It's always good to have you over. But yeah, so we're coming towards the end of the webinar now. I'm conscious that we still have time for a lot of questions. So in the meantime, I'd like to give everyone a demonstration of how easy it is to build a portfolio on Invest Engine. So add a new portfolio. Given that we're building this ourselves, it fits under the do-it-yourself portfolio. We'll filter the product provider by Fidelity in this case, which gives you all the ETFs that we currently have provided by Fidelity. And given the selection that we have here, we'll look at some US Research Enhanced, so that's their US equity products on the active front, so we'll add that in the portfolio. We'll look at Global Quality Income, and each ETF you're presented with a price chart, an ETF description, giving you quite a comprehensive overlook of what this ETF covers and the exposures, together with a dividend yield in this particular case, and also the breakdown on a holdings, region, and sector level, which will be useful later. So use those three ETFs, put some bonds in there in emerging markets. Fantastic. And once we're happy with that composition, Then we get to fine tune the application of each of the ETFs even. We hit continue in this case, and you can see that you've got a target breakdown of what the regional look through would look like, the sectors and holdings. Note that I'm going to show that you can see that some of it is missing. That's the fixed income part, which we do not have a breakdown for at present. But we hit continue in this case if we're happy with it. And that is how quick it is to build a portfolio invest engine. We also have features such as auto invest and savings plans. So a savings plan allows you to invest automatically through a period of time. So your investing journey is on cruise control, which is very, very handy. But other than that, and that's a portfolio created. But on that note, I will hand that over to Kieran.
Thanks very much, Goncalo. Thanks for going through that. So yeah, I'll just open it back up to a few of the questions that have come through. So Elliot, some really interesting stuff that you covered. One of the questions has come through. If I'm a long-term retail investor, how can I use the knowledge of everything you've talked about in the presentation through cycles to an international advantage through diversification?
God, give me some tough questions today, Kieran. My goodness. I think the first thing that you would have to do is definitely, I mean, one of the things I'm a big fan of just personally is Ray Dalio's work. So for anyone that's interested in some of the stuff that we've talked about today, I've used a lot of that knowledge that I've had from YouTube, and that can be just understanding, some of these cycles. And Ray Dalio does a great YouTube video, which is principles for dealing with a changing world order. So definitely YouTube that. That will also give us some more background on it. Of course, the books, I think, only like 20 quid on Amazon. So definitely have a read. In terms of how you can then think about positioning yourself, again, it just depends on how comfortable you feel with having certain risks. And also just, I always think, it's getting a good understanding of maybe bouncing your ideas off of people. Particularly, that's one of the things I get a lot of use out of. So again, I would go back to, if you're feeling uncomfortable and you want some guidance on the portfolio, maybe speak to a professional investor. So a financial advisor, I think would help with that particularly.
No, that's great. And also touched on the rate cuts, which are obviously, constantly big news over the last kind of 6 months or so, and we're expecting more of those to come. What's your kind of overall take on how that's going to affect things going forward?
So again, a very good question. So again, I'm going to put my finger in the wind here because I'm sure whatever I say will end up probably being wrong somewhere along the line. So I would say, if we see rate cuts start to come down, I think that's quite a good thing. I think, we look at some of the data that we've already mentioned, the jobs numbers. It does seem that, they've kept rates high for very long, and that's because they've been very worried around letting inflation get out of the box again. I know policymakers across the world have felt that. I mean, if you completely slightly different example here from the Fed, but if you look at the Bank of England, they started the year saying they were going to cut rates 6 times by 25 basis points, so 25 bips. We've had 3. The inflation in the UK is now nearly 4%. Are we going to see another rate cut? It's unlikely, but I mean, it could happen. Then look, I said the point specific on this question for the US. I think it will probably provide maybe a good tailwind for some US at the moment, given what's likely seeing at the moment, just because it will help to support it moving forward. Of course, that more liquidity, businesses can borrow more money, and of course, it helps to support the economy. However, I think maybe they've kept rates too high for too long, and we've said maybe it's going to be a point of no return. Again, I mean, I'm finger in the wind, not sure. So, I suppose the answer to the question is I'll probably be wrong anyway, Kieran.
And then I guess also one of the other points you kind of referenced in the presentation was around that US has historically been the best place to make money over the last few years. And when we've touched on China and as potentially a rival for that going forward. Do you think there's any specific signs people should be looking out for when that kind of shift is moving, maybe to China or maybe to another area of the world? Is there any kind of key signs or key signposts people should be thinking about?
That's, again, a good question. I would say probably where is seeming to be mostly focused on the rise and positive for new businesses is probably the best thing you can think about, right? Because if you look at the world today and we look at the Magnificent Seven, 20 years ago, they weren't even businesses anymore. And then before that, they changed all over again. So every couple of years, we see these major businesses take over the world, and then of course they start to change. So I think who's favorable to new businesses will probably maybe give some indication. Now, to both of those examples, both the US and China are both very, very positive on new types of technology. So I think it is difficult for investors, and I do think you have to just keep doing your due diligence. I think, unfortunately, is probably the worst thing about it. There's no simple answer to that question.
Okay, and you mentioned tech stocks, which is obviously, big, but very prevalent within the Mag 7. In terms of volatility compared to previous bubbles, what should people kind of look out for and keep in mind with tech stocks specifically?
Yeah, I think, again, this is not financial advice by any means, but just be aware of, how exposed are you to certain areas. If you're feeling uncomfortable, I would always, of course, encourage you to speak to a professional, but just have a look at it and say, if I'm 100% in technology and I'm really worried about technology, does that make sense? Do you know what I mean? It's like, just have a look at what you're owning. Does it align with what you're feeling? And again, if you're worried about it, maybe look to diversify. I think diversification, as we've seen, is really prevalent, particularly in the first half of this year. You look at the markets at the moment, some of these markets are going really well, things like the commodities market at the moment. So you can see the likes of gold and silver and platinum and palladium, uranium, all doing really well. So I think it's about being diversified again. But if you're wondering for where to find more information on this, you definitely speak to a professional investor. Advisor will always help you with that. But just use your brain. Be sensible. Think about diversification, and if you're feeling worried, reach out to people and help to get some experience.
Okay, great. And obviously we're all UK based. How do you think maybe as a UK investor, our experience might differ from a US investor or maybe even a European investor, given the kind of same macro environment that we're in?
Ooh, that's a very good question. Thinking about the UK market at the moment, because it is very tough, and I think I say it's tough, and then there are some similarities, right? Like you look around at some of the feelings that people are feeling out there. It certainly is, polarizing, to say some of the points you see in the news. I think you have to just be aware that I think, maybe not taking too many big bets on certain areas can be an area, but of course that's where diversification then comes in, right? Don't be super, super bullish on one thing. I think being super diversified probably is really helpful. So for a UK investor compared to a US investor, I think there are some similarities in how we've been positioning, particularly from people thinking about getting risk assets. Would you want to own UK equities or UK assets? I think that's been one of the areas we have seen people maybe wanting to move away from because of the government. But again, I mean, how much of that is propaganda? How much of it is real? Again, you have to go back to doing your own due diligence and looking really underneath the bonnet, I think, of those things and being aware of it.
Sure. Diversification obviously been a massive, massive theme of this, which is always good something to look at. And I guess finally, with all the kind of talk of cycles, and obviously your presentation kind of focused on empires, is there such a thing as a kind of timeless investing wisdom, and what do you think that will be?
Well, that I think is I think goes back to good diversification, owning different types of assets. I think Goncalo put it very well. If you're feeling really quite risk averse, and again, it is a very individual thing. You want to own, equities, fixed incomes, commodities, etc. That is up to you. But of course, if you're unsure on that, don't take my word for it. Go and speak to a financial advisor, get some advice. So I would say diversification is one of the timeless wisdoms, but also is being aware that time in the market beats trying to time the market. I think those are very well evidenced everywhere. It's not about panicking; it's about remaining level-headed. And I think that's why I think a financial advisor is a great toolkit, because it's someone that's very experienced that you can lean on during times when you're feeling very concerned around things. So I think diversification, time in the market, not trying to time the market, and just riding through volatile periods, I think is one of the best things. And I think for everyone that's been an investor since 2020, it feels like we never quite get away from what they class as interesting times. So.
No, thank you very much. And just to open a few more up to Goncalo. So, how easy is it to change choices made of ETFs?
You've put me on the spot because I did close the demo, but I was about to run it down again. But no, it's incredibly easy. So once the portfolio has been set up and you've been invested, you're more than happy to make changes and rebalance on other ETFs if you see fit. But the beauty of ETFs is that you can trade in and out quite rapidly, assuming the units have settled. Nothing like a mutual fund every now and then. So it's incredibly easy to summarize it. You can buy in and out of an ETF and have the trade settled in less than a week, which is quite convenient in this day and age.
Okay, no, that's great. And one of the other questions that's come in around Fidelity specifically, I know you showed on the demo earlier all the different Fidelity funds that you can buy. So one of the questions was around if there's a single fund that covers global and underdeveloped world. So I think the kind of advice there will be just to log on and kind of be able to scroll through and have a look yourself, right?
Yeah, no, absolutely. I mean, our catalog of Fidelity ETFs is very comprehensive. There's plenty of ways of playing this particular exposure. So my advice would be just to log onto the platform and see which way best way it is to play it.
Perfect. Well, thanks very much everyone for your time and logging on today. It's been really good to chat. Thanks very much to Elliot for the presentation, really interesting, and thanks for to Gonzalo for running through the Invest Engine platform. Some really interesting stuff there. And like I say, thanks very much everyone for joining, and we will see you on the next webinar coming soon.
Thanks, Kieran. Bye, everyone.
Cheers. Thank you.